Good evening to everyone present here today. We have our product manager Jason D'Souza who will show us how to find the right mutual funds. Towards the end, we would also be having a Q&A session. Over to you, Jason.
A very good evening to all present here and welcome to today's webinar. I had previously done a deep dive series on mutual funds, and I remember I had taken you across the website and showed you all about the research, what we offer on mutual funds. And now MarketsMojo has gone through an upgrade. We are also offering free transactions to our investors. I think now is a good time for you all to actually understand about the different types of mutual funds. I've planned to keep a series of episodes. So today we'll be talking about one particular thing and there'll be 2 more episodes coming up. I don't want to overwhelm you all with a lot of information. So today we'll just talk about the basics, the different types of mutual funds. Okay, so without wasting any time, a disclaimer: investment in securities is subject to market risk. Past performance should not be construed as a guarantee for future returns. Okay, so before I start off with the event, I want to just show you all what's new. A lot of you all might actually know about it, but I'll quickly take you on the website. So we're introducing free mutual fund transactions. You can research across the best mutual fund. Now you can transact in any mutual fund free of cost. And you can also monitor your portfolio on the mutual fund tracker. Okay, so I'll quickly take you on the website and show you what exactly is this new feature. So now as we are on the website over here, if you just click on mutual funds, which is the 4th option. Okay, so this is divided into 4 different things over here. You can research the top rated funds, okay, across categories. You can have a look at your portfolio. It's really easy to import your portfolio onto this particular portal. You have to just add your PAN card and do an OTP verification. The best part about this is that you can get all your mutual funds in one place then. So I kind of know, okay, I have this particular mutual fund, which is a sell ranked. I have this particular whole rank mutual fund, so on and so forth. Okay, so this is the import portfolio button. It's a 1-minute thing. And lastly, the new part, which is the transact in your chosen mutual funds. Okay, so you can obviously just go and buy any particular mutual fund you want. Okay, and it's free of cost. We don't charge any commission on this. Okay, so this is a new feature. Another new feature before I move on to the presentation is that you can search any stock, mutual fund or ETF with its rating. Now this was a major feedback we used to get, and we thought, why not we implement this for our users. So as I can show you the screenshot over here, as you search a particular scheme or let's say a particular stock, you get an option to first check across different classes, and also you can see the score, whether it's rated and what's the ranking. Okay, so if I'm on any particular page, I can just simply search. I can simply search Adani for example, and here you can see I can get the entire rating for all the particular Adani stocks. Okay, and if there was mutual funds, I could see that as well. Okay, so these are the 2 new features we have recently implemented. Okay, let's start off knowledge series. What's going to be our journey? What exactly am I going to cover in the next 3 episodes of this particular mutual fund series? As today, as the topic says, we'll be covering the different types of mutual funds. I'll be going into the basics of it. Okay, many investors who are there over here might actually understand most of what I'm covering today, but I'll try my best to add in something more which is not actually there on the website as such. In the next episode, I'll show you how to select the best mutual fund and how to actually measure its performance and benchmark it. Okay, after understanding all the different types of mutual funds, what's more important is now how do you actually rate them? How does MarketsMojo rate them? How can you shortlist to your top mutual fund for your portfolio? And the third and the final series would be more of creating a portfolio with mutual funds. Okay, I'll show you how to actually allocate your investments into mutual funds. We'll take different investor appetites, risk appetites, and see how we can actually create a portfolio of mutual funds. So I hope these 3 episodes actually completes your entire journey when it comes with mutual fund investments. What exactly are we going to do in the first episode today? Starting off, 2 rules to always keep in mind while searching for mutual funds, okay, while investing in mutual funds. These are 2 important rules, and I'll be starting off my webinar with these 2 rules. Okay, categories of mutual funds, just the basic categories. Understanding the different type of equity mutual funds. What are the different types? Okay, should you consider ETFs? Now, I'm not trying to mix and match ETFs with mutual funds, but I'll show you all, should you all consider ETFs? When should you all consider ETFs? And how it can actually fit into your portfolio. And the third one is debt funds. I see a lot of investors ignoring them nowadays. So I'll spend some time on what exactly are debt funds and how can MarketsMojo help you all increase your debt allocation in your portfolio. Okay. Starting off with the first part, which is the 2 rules I want to talk about today. why you should be selective when it comes with mutual funds. Why you should not simply run and buy any particular mutual fund in any category. The reason for that is very simple. What I've seen is that your call on a sector can be right. So you might be right that IT will perform over the next few months. Your call can be absolutely right. Okay. Your call on the market cap could be right. You actually know that mid caps would perform, or large caps would perform, or let's say small caps would perform. Even that could go right. Okay. And the call on the asset class. So let's say you expect debt to perform well, or you expect equity to perform well, whatever it is. Your calls could be right. Your idea, your approach could be right when it comes to investment, but you could still underperform. You can still underperform. I've reviewed all the different types of mutual funds, and there's a big disparity, a big difference when it comes to the top ranked and the bottom ranked mutual funds. Okay. So even though your calls are right, your approach is right, okay, your selection is right, you can still underperform. And that's the reason we are helping you out with some ratings. Okay. So why you should be selective with mutual funds is that if you want to invest in any particular category, any particular, let's say equity large cap, don't run and buy the first one which comes in your search option. Take some time out, research, okay, understand the different risk pointers of that particular mutual fund, and then go ahead with investing in it. The reason for that is very simple. Now, for example, if you see equity fund large cap, okay, two funds in the same period, and look at the difference in the returns. IDBI India top 100 looks at the top 100 market cap funds. Similarly with DSP top 100 equity fund. But still the return, the differential is as much as 2x. As much as 2x. So you could have been right that equity will perform over the next 3 years. You could have been right that the top 100 funds would actually see the most returns. But still, if you are not with the right fund, you're not actually understanding who the fund manager is or what's the actual portfolio composition, what's the final rating, you can go wrong. Be selective. Don't rush when it comes to picking a mutual fund. Spend some time out and be very selective when it comes to picking any fund in a category, in an asset class, or however it is. Okay. That's the first rule. Talking about the second rule, this is very important. And the reason I added this rule is that we were recently talking about this during our launch on Friday. And Mohit made this particular statement. And I was looking at the chat box and I realized a lot of investors have a confusion on this. What exactly is this? That I want you all to start looking at mutual funds as an instrument, not an asset class. Okay, when I speak to a lot of my friends, and I ask them, do you all invest in stocks? Yes. Okay, so do you all invest in are you all investing in mutual funds? The answer is simply yes. Okay, but what exactly are those mutual funds? Are you investing already in equity and again investing in equity mutual funds? Have you invested in equity and then investing in debt mutual funds? So don't look at mutual funds as an asset class. Okay, mutual funds mein dal raha hu paisa, main stocks mein bhi dal raha hu, I'm putting money in ETFs. No. Within mutual funds, you have to understand your allocation well. Otherwise, you might have a very risky or a very less risky appetite when it comes to investing. What exactly is this? I'll break it down in the next example so it becomes clear. Why does the allocation go wrong? Let's say Arjun has a moderate risk profile and invests in stocks and mutual funds. You consider yourself as a moderate investor. Okay, and you're investing in stocks and mutual funds as well. Now, since he's a moderate investor, what he thought is that when I invest in mutual funds, I have 5 lakhs in hand right now. I'll invest 60% in equity, which is some 3 lakhs, and 40% in debt. The reason I'm investing in debt because it's less volatile. Okay, so I have 5 lakhs right now. I'm investing 60% in equity, 40% in debt. And I feel I'm very moderate with this particular approach. Obviously, because I'm not crossing a very high equity exposure. But when you consider your stocks as well, for example, this particular investor, Arjun, has 10 lakhs now in stocks, which is 100% equity, which is as obvious. When you look at his overall allocation then, when you add the two, you can see his equity exposure is as high as 87% and only 13% in debt. Even though he has a moderate risk profile, when you add both these instruments, his equity exposure increases massively. His overall allocation has 87% equity, making his investments more risky and volatile. Okay? And always look at your overall investments and not just the mutual fund portfolio. You adding money into mutual funds doesn't complete your task. What are the types of mutual funds you're adding in? And what's the asset class breakup within that mutual fund is important when you look at your overall net worth. Okay, so just because you're putting money in mutual fund doesn't make your portfolio less risky or doesn't bring down the amount of risk you're having. If you invest in small cap equity mutual funds, they might be actually more riskier than your normal portfolio. Okay, so stocks is your equity personal portfolio, and when you look at mutual funds, you'll have to look at them as both, because you have to consider your overall risk profile as well. I hope this example gives some idea. Okay, and now speaking about why does allocation go wrong, I don't know if many of you all know. There can be a risk of over diversification when it comes to mutual funds. These mutual funds have 50 to 70 stocks in their portfolio. Okay, and now let's say you want to invest in large cap stocks. You want to invest in the top 100 large cap stocks, let's say. You have a choice of buying one good mutual fund which invests in the top 100, or you have a choice of buying 5 or 10 different mutual funds which again invest in the top 100. You have to understand, as you keep increasing the number of mutual funds, you're virtually investing in all stocks. So one mutual fund might have, let's say, 50, 70 stocks. Another mutual fund might have 50, 70 stocks. And when you add both of them, you might get 80 to 90 unique stocks out of 100. So there can be a chance of over diversification. You'll be adding all stocks in your portfolio, you will never go right. You'll actually get returns probably less than the benchmark also. So purchasing too many funds from the same category would lead to over diversification with less chance of actually beating the benchmark. Okay, so now that we've actually covered these two different rules, I'll now go to the next part of the presentation, which is breaking down different categories of mutual funds, and then let's talk about equity, ETFs and debt. Okay, so now when it comes to categories, these are very simple, but I know many investors actually go wrong with this. Before you even think of, let me look at a hybrid portfolio, okay, let me look at a small cap portfolio, or let me look at a banking and finance sector portfolio. Before you look at all of that, you have to take one step back and understand the basic categorization of mutual funds. Now this might be really simple for, let's say, very professional investors or professional investors, but for the newcomers, you might get some learning over here. You can look at the structure of the mutual fund, as in an open-ended scheme, close-ended, or an interval. What exactly is this? I'll explain you in the next slide. You can look at the management. Now this is very important. Many of you all don't even actually understand between the benefits of passive management has versus an active management. What exactly is this? Which one should I put my money in? Okay, we'll cover that. And lastly, the objective. 3 basic objectives. One is growth, regular income, which is more of the dividend schemes where you get some money back, some of your capital back. And lastly, liquidity of funds. There can be a different objective altogether. Let's break down 3 of these very quickly. It's not very difficult to understand them, and then we'll go ahead. Starting off with structure, you can have open-ended funds. Now, as the name suggests, open-ended. You can actually buy that mutual fund at any particular time and even exit from that particular mutual fund. Okay, it's available for subscription and repurchase on a continuous basis. Most of the investors go for open-ended funds. Okay, most of the investors, when I see their portfolios, they go for open-ended funds. And the reason for that is that it's much easier to actually buy them and sell them back to the mutual fund. Whereas closed-ended funds have a fixed maturity date, and you can only buy these closed-ended funds during the time when the mutual fund has been offered in the market. That's the only time you can actually buy it, and you can only redeem it at the date of maturity. Okay. Now you might be asking me, what's actually the benefit of having a closed-ended fund? It has so many locks in place. So now closed-ended fund, what happens is that there's less money coming in and out of the mutual fund. The mutual fund manager has more time and energy in focusing on those funds and actually buying different stocks. Okay. And another thing about closed-ended funds is that it gives you a habit. It gives you some psychological kick that, okay, I am now going to put my money in this fund and I'll not look at that money for the next 5 or 10 years. So we have a set of investors who actually look at closed-ended funds. There are different reasons for that, which we'll also cover. And one thing which is another hybrid between those is an interval fund. Okay, where there's a particular date where you can enter or exit, which has been defined. Okay, this is very basic. This is just the structure. Moving on to the next part, which is the management. Now let me spend some more time over here. We have an active approach when it comes to managing mutual funds. Any particular mutual fund manager could have an active or a passive approach. And the reason for that is simply, is he trying to beat the benchmark, or is he trying to give you returns in line with the benchmark? That's the basic diversification. In an active approach, the fund manager actually sits with a team of research people and finds the best stocks to invest in and then creates that particular mutual fund. It might not be stocks, it can be debt, debentures, bonds, so on and so forth. Obviously, since he has a team and he's actually talking to all of them and finding out, the expense is slightly higher when it comes to active mutual funds. And the reason it's active because the mutual fund expects to generate better returns than the benchmark. Okay, he's actively managing it. He'll expect you to pay a bit more than a passive mutual fund. Because the passive mutual fund, the goal is very simple. I have to mimic the index. Okay, a passive mutual fund might just mimic Nifty 50. Okay, it won't think much. Whatever the constituents are there in Nifty 50, it might, actually add all of them, or it might add some of the stocks of Nifty 50. But its goal is to just mimic the benchmark's return, the volatility and so forth. And now since it's only mimicking, it has lower expense when it comes to passive mutual funds. So the management I've written over here is the management for the mutual fund manager. How is he looking at the scheme? Okay, how has he created the scheme? What's his approach? Okay, so we're done with structure and management. Last part is objective, which is, I think, much more simple and straightforward. We have growth mutual funds. You might find the mutual fund and dash, and you might find the initial G. So what exactly is the G? The main goal of that particular mutual fund is to grow via capital appreciation. Okay, many of us follow that particular approach when it comes to stocks. We have a regular income, which is a dividend approach also, where we think of collecting some amount back. We want some regular cash flow so we can invest, in an IDCW fund, which is, you can actually get some amount of dividends and interest collected back. And lastly, something which is liquidity. Okay, the purpose of this fund is just to keep your money in place. Let's say you want to invest or remove that particular money tomorrow. We'll also spend some time on liquidity, which will actually help us understand debt funds. How you can actually park some of your emergency funds or actually look at parking some of your funds in debt funds. That's the simple breakdown of categories of mutual funds. Okay, this is the basic objective which a mutual fund launches. It has to, satisfy these three different things before it comes out with a mutual fund. Now, what's in it for you? How can you actually use this knowledge in then breaking down and selecting your own mutual fund schemes? What's in it for you? Let's say you would like to invest in a fund to achieve better returns than the benchmark. You're trying to beat the benchmark. But it also should give me some regular income. So if you see this line I've put over here has two particular breakdowns, has two particular terms. Since you're looking at achieving better returns, you'll have to look at an active exposure, not a passive. Since you're looking for regular income, you'll have to look at a dividend scheme, not a growth scheme. So based on what you want, based on what's your preference, that's how you have to break up and actually understand what fund you can actually dig for. Any funds on website, I'll quickly take you on the website, okay? And I'll show you how you can actually research. Okay, so since you're looking for an active fund and it should give you dividend for regular income, you can simply search dividend over here and you can get all the mutual funds in that particular, in that particular category. So this is equity category dividend yield fund, as you can see over here. Now, as I'm on this particular dividend category, I can simply get the ranking here itself. I don't have to actually go and search. This particular thing gives you, look at all the dividend yield funds and it will give you the best one over here. So among the 8 equity dividend yield funds, this particular one has a buy rating. Okay, and you can get some more information about the mutual fund over here as well. Okay, and this is the return evaluation. So very simple. If you want to particularly search a mutual fund scheme, you have to understand those 3 different categories and then search it on the website. As simple as that. Okay, let's say you are already invested in stocks, so you want to invest in a fund which is less volatile. Okay, less volatile, you want to simply mimic the benchmark. In that case, you can look at ETFs or any particular index fund to actually invest in. Okay, I've written these 2 lines. One of you might be wondering why has he written these 2 lines. It's just that when you go back now and you're thinking of any particular investment, you'll have to know whether you should look at an active fund. You'll have to know whether you have to look at a growth fund. Okay, so you will have to actually understand this thing should actually speak back to you when you go to search a particular mutual fund. Now I've broken down the categories. I also showed you all 2 important rules. I think now we are fit enough to actually look at the different types of mutual fund schemes. Okay, so let's review some specialized mutual funds and understand its role in our investments. When I say specialized, I'm talking about different categories further. Okay, different types as to, equity has a lot of different types. We'll take care over there. Yeah. Sector funds. If you want to have an exposure in a particular sector, there are a number of things you can actually do. let's say you believe that the IT sector might do well. You can simply go and buy Infosys and TCS. What if Infosys and TCS don't perform? What if you actually admit that there's a better fund manager in the market who can actually pick the best IT stocks for you? That's when you can look at a sector fund. In a sector fund, the manager, the person who's managing that particular mutual fund, he will do the job to pick the best stocks from that particular sector. So if you believe that any particular sector is the right time right now, a sector mutual fund is a nice way to actually go about in getting exposure in your portfolio. Okay, these funds are risky. It goes without saying. You're investing your money in a particular fund which is in a particular sector. Trust me, the drawdown can go as bad as -40 and -50. When I say drawdown, let's say you invested 1 lakh, it can go as low as 50,000 as well, because sector funds are very volatile. They're skewed to a particular sector. I'll also be breaking down sector funds in the next 2 slides. But before that, let's look at solution-oriented funds. Have you all ever heard of these particular schemes? Retirement planning fund, or let's say children's fund. Since I'm talking about a long time, let's say retirement planning, these funds are in the market and they are closed-ended. Remember, I spoke about closed-ended schemes, is that you can put your money in the retirement scheme, you can't remove it out. Let's say for a lock-in period of 20 years, 25 years. The name is solution-oriented because it gives you a solution only after a particular year. You have to put your money and forget it for a particular period of time. I personally don't like these particular funds. Now, since I'm actively in the market, I don't want my money to get locked in a particular fund. Let's say you've bought a particular retirement planning fund and that fund is not performing right now. You'll have very less chances to actually exit out. Okay, so I'm not a big fan of solution-oriented funds, for the main reason is that my money is locked in with someone and I have to trust him for the next 10 to 15 years. We also have commodity-focused stock funds. Okay, these funds focus on a particular commodity. If you're actually running for a commodity play, if you think that, let's say cement is one thing. Now, so for example, in this particular budget, the government has spoken a lot about infrastructure. Do you think that infra might be the next move? You can pick a fund which focuses on those commodities. So I think I was seeing an ICICI Pru commodity fund which has a lot of investment in cement stocks. It has a lot of investment in steel and oil stocks. Now with infra being the next big promise by the government, these particular funds can also perform well. It's not a recommendation here, but this gives you an idea on how you can take exposure in the market with these particular news articles. Now I said I'll spend some more time on sector funds because I think I should take you all there. Now I've spoken about sector funds, a lot of you all might think it's very easy to pick these sector funds. But when you look at sector funds, I've written down all the different sector funds you can actually get in the market. Some of them are actually there in the Indian market which are trading, and I'm going to put the 1 year and 5 year returns. So the first 4 are actually available. These are different categories. Now when I look at the return of these particular funds, now if you see here, the 1 year return for utility fund is -0.45. This is the 5 year CAGR, which is 11.14%. Okay, similarly, technology funds, if you see the 1 year return is not that great, -9%. IT stocks are not doing well last year. But the 5 year return is the highest across all categories. Similarly, with finance, it's 8.31, 8.45 CAGR 5 years. And with healthcare, it's gone down, but it's 12.46. The problem with this is sector rotation is prevalent. It's very difficult to actually bet on one particular sector and say that this one will perform consistently. Because you can see in 5 years, let's say 1 year ago, when you are about to invest, you would see, okay, 21.22% 5 year CAGR for technology funds. I'm going to invest in technology funds this year. 8.87% down. So it's very difficult to actually catch a sector because just before the sector is on the up move, none of you all might actually know that sector would perform. I have another chart for you over here. This is the Nifty 3 year trend. Okay, the 3 year trend of Nifty, let's say from Jan 2020 to Jan 2023. Okay, and in this 3 year trend, I've actually identified which were the best sectoral runs. So if you see from March 20 to July 21st, Nifty Pharma Index went up by 115%. I looked at another healthcare fund, Mirai Asset, randomly, it went up by 128%. Now you have to actually understand that you have to get in at that period and exit at the right time as well. Because after July 21st, that particular pharma fund did not do well at all. Okay, so even banking and finance, if you remember from September 20 to Feb 21st, the Nifty banking and Nifty finance did actually well. I've picked another mutual fund over just to give an example, which has given 65. It's not actually outperformed the index. And another example with the IT sector doing very well from May 21st to December 21st, getting some 51% return. another fund which has got 51%. The thing about this is that you can't simply put your money in one sectoral fund, let's say on March 20, and hold it for the next 3 to 5 years, because sector rotation is much more prevalent right now. Things are much more dynamic compared to 5 and 10 years ago. So if you're thinking of putting your money in sector funds, please understand you will have to quickly jump in, jump out, jump in, jump out. It's not going to be that simple. Now, talking about some other specialized mutual funds. We've talked about the 3 main equity categories, but there are other specialized mutual funds also, which I think some of you all might not know about them. The first one is market neutral funds. And these funds aim to get money both in rising and falling markets. Now, when I looked up across the different funds available, there were not many, but I came across this particular website of a Vendis fund, which was actually saying that it gives a particular market neutral fund. These funds are actually more available in the West. They're not actually available in India as of now, but I would like to see them come up soon. They have a long and short position, so whether the market is going up or going down, it seems it tries to generate a certain amount of return. Currently, it's not available, so let's move further. We have inverse and leverage funds as well. And you might not know, some of the inverse funds try to get 3x% return off the benchmark. So let's say Nifty is giving 15%, it might look at giving 45%. How is this possible? Obviously, they're using some derivative contracts. They're using some future and options, because with some little money, they're planning to get some 3x return, 300% return, so on and so forth. Not currently available in India, and I think it should not be available in India. We've not really done well in the derivatives and future market. Something like this would be much more riskier. But I'll be waiting for these funds to also be released in India. Moving on, some other funds. We have fund of funds as well. What I mean by that, you can invest in these funds also invest in different mutual funds in the market. I really don't like these funds, because think about the amount of diversification. You're a mutual fund scheme. You're investing in a mutual fund who's already investing in 50 to 70 stocks. And then investing in another fund which already invested in 50 to 70 stocks. I think it's too much over diversification when it comes to fund of funds, but you have to actually understand the category if you would like to pick it up. And lastly, index funds, which is often confused with ETFs. What happens in index funds? Let me explain it to you. You might think of investing in a particular index, let's say Nifty 50. But you don't know which stocks from Nifty 50 will actually do well. You can invest in a Nifty 50 index fund. Okay? And what that particular manager of that index fund does is that he looks at Nifty 50 and tries to pick the best ones in that particular index. So from those 50 stocks, he'll try to pick the best ones and create his portfolio of mutual funds. This is very similar to what we call as an ETF, because both of them are trying to, replicate the particular benchmark. But there are benefits for ETFs, where I'll now take the presentation towards ETF. There are benefits for ETFs versus mutual funds and vice versa. Okay. ETFs generally offer lower expenses. Okay. And index funds or mutual funds would have better trading decisions when it comes versus ETFs. I have another slide after this which actually breaks it down further simple. So let me take you to that particular slide. Okay. If you want to gain exposure to a particular index, what you should do? Let's say I want to invest in Nifty 50. What should I do now? Should I buy an index fund or should I buy an ETF? What should be my particular approach? Let me break it down for you. So mutual fund versus ETFs, which ones you should go for? The first thing is the cost benefit. Okay. And what I mean by the cost benefit is that ETFs are usually passively managed. Remember I spoke about active passive. A passive fund is actually just trying to mimic the benchmark. So you're saving a lot on expense due to low or no management fee. Okay, so when you look at cost benefit, ETFs have a better expense ratio. Price discovery. ETFs is one particular thing which actually trades like a stock throughout the market hours. But mutual funds, you just have an end of the day NAV which is considered. So if you want something which is very, let's say, has a high liquidity, then you could look at an ETF instead of a mutual fund. The third benefit is a tax benefit. Now I won't dive in very deep. People who understand accounts actually knows this. ETFs and the way mutual funds are made are quite different. ETFs has some creation and redemption process, which is not a taxable event. Whereas when you redeem a mutual fund, you might have to pay some taxes. So even in tax benefits, ETFs is actually better compared to a traditional mutual fund. So cost benefit, tax benefit, price discovery. Why should you actually even go for an index fund when you have an ETF which has 3 big benefits? The only one good reason I found to invest in an index fund versus, let's say, an ETF is the style of investment. You can't have an SIP and ETF. So an ETF is just trading like a stock, so you can't have an SIP. But let's say you're quite busy and you want to just invest, let's say 10,000 into Nifty 50 for the next 10 years. That's when you can look at an index fund. Because you can't actually have an SIP or a systematic transfer plan when it comes to particularly ETFs. So that's the one reason I thought where you could look at an index fund versus an ETF. Okay. So hence ETFs, there are some good benefits when it comes to versus mutual funds, and you can consider them. You can take a screenshot of this particular slide to actually get a better understanding on what you should invest in. Okay. The last part of this particular presentation is what are debt funds? Should I invest in them? So before this presentation, I spoke to a lot of investors. I spoke to a lot of people in my office as well, and I asked them, do they invest in debt funds? And most of them said that if they have money, they don't actually look at debt funds, they look at fixed deposits. And that's not the thing with just my office or my friends, it's the thing with the entire nation. A very less amount of retail investors actually look at debt funds when it comes to investing in debt. They simply go for FTs, or they don't actually park their funds. But institutions, big institutions actually put a lot of their money into debt funds. The reason is quite simple. Debt funds are less volatile in nature. When I break down how a debt fund works, you will realize that it's very less volatile compared to an equity or a particular stock. Now, what exactly are these debt funds? How do they earn money? So we know that when a mutual fund invests in a stock, the stock price goes up, the mutual fund's NAV improves. But what exactly drives the NAV for a debt fund? So what does a debt fund do? A debt mutual fund invests in bonds and deposits. I hope you understand the concept of a basic loan. When you take a loan from someone, you have to particularly pay interest on that. That interest, what it collects, actually helps that particular debt fund, that debt mutual fund to grow. Breaking down some factors for you, it earns interest on deposits. And even if the price of that bond increases, that's when the debt mutual fund actually benefits. Okay, before I go on whether you should invest in them, let's break down what exactly are debt funds. Uske andar hai kya, how it exactly earns. When it comes to earning, it earns interest on different deposits and if that price increases of that particular bond. Now, debt funds versus FDs. This is a big choice people make and they actually go with FDs. And I don't blame them because I think that the nation has lack of knowledge when it comes to how debt funds work. Debt funds are tax favorable when it comes versus interest on FDs. When you get interest on FD, you have to pay a particular tax. Okay, that's not actually there when it comes to debt mutual funds. And also, if you understand that debt funds are liquid, Mr. Sunil always says that if you want to invest in the stock market, you should at least look for minimum 3 years. But what if you don't want to park your money for 3 years? Let's say you have money right now and you want to spend it after 1 year, let's say for your marriage. You can't invest that money in the stock market. Where exactly you put that money? Where exactly you put your money which is not there for at least more than 3 years? Let's say you want some money for 6 months. Where exactly you should put? Now in 6 months you don't get FDs for 3 months. It's very difficult and you hardly get any interest. That's when you can consider debt funds. You can consider debt funds as an investment when you have a very short time frame and you want to put it for a while because it's liquid at the end of the day. In FD, if you put your money for 1 year, you have to look at it after 1 year itself. Versus debt mutual funds, if you put your money, you can actually redeem it back. So in that case, versus FDs, it has a higher liquidity and it's also tax favorable. I like this particular option, which is a flexibility. It's a systematic transfer plan. What exactly is this? At one particular time of the month, or as you set it, so we all know about an SIP, where every particular date of the month you add some money. And STP is a very nice way, and I'm actually going to use it out when it comes to transferring your fund from one mutual fund into another scheme. So what I believe, how you can actually use this when it comes. Let's say you have 10 lakhs of investment, and let's say you have 2 lakhs of investment into debt and 8 lakhs into the equity market. Now, as the situation improves, what you feel is that this 8 lakhs of equity can now become 9 and 10 lakhs. You can start a systematic transfer plan on that debt mutual fund. And every month it will transfer from the debt to equity. It will transfer, systematic transfer plan. So with debt mutual funds, it has a better flexibility option. Now you can't do that with FDs. You can't do that when your money is in the bank. You can't tell that FD, every month you put 10,000 into the equity market. It's not possible. But with debt funds, it is possible. Okay, so with STP, this is what I'll be covering in the third episode, is how you can actually look at your debt funds and start transferring it to equity from equity back into debt. Okay, so that your overall portfolio can be less volatile. You can actually reduce the amount of equity if you don't think the market will do well, or increase the amount of equity if you're bullish on the market. And I think it's the best alternate when it comes to FTs, as I said. There's no penalty on early redemption. You can redeem anytime. Some of the debt funds you can redeem very ASAP. But when it comes to FTs, you have to pay a particular penalty. Okay. So how to select from debt funds? I want to only focus on these 2 points. Now, debt funds as a concept, debt as a concept is slightly complex and people don't actually pay attention or actually try to understand them. But when it comes to debt funds, remember these 2 simple things. I've highlighted them in dark. Understand the maturity of the debt the mutual fund invests in. The shorter the maturity of the particular loan that debt mutual fund invests in, it has less risk and obviously less return. And credit rating of the debt issued. I don't know if many of you all actually understand credit ratings, but if it's a AA plus credit rating, it has a higher credit rating and it's safer to invest in versus the lower ones, A, BB, C, and so on and so forth. So higher the rating, lower the risk. So when you want to put your money in debt, simply remember these 2 points I've said. Because when you understand these 2 points, it will be easier for you to put your money in which debt mutual fund. I'll take you on the website and show you some of the different debt mutual funds and how you can actually think of adding them in your portfolio. So as I'm on the website over here and I go to research any mutual funds, now the best part about this particular screen is that you have different categories in boxes here below. So if I simply search debt, okay, I start coming to debt mutual funds. So you can see debt, banking and PSU fund. So what this particular mutual fund does is that it invests in debt of different banks and public sector units. Then we have a debt dynamic bond fund. Okay, I remember I spoke about the maturity of the debt. In a dynamic bond, it invests in debt of different maturities. So this is a whole pack, a whole family pack. If you don't want to actually, understand which fund to invest in, short term, long term, understand interest rates, you can keep all of that aside and look at a dynamic bond fund. Okay, then it comes to corporate bond funds, which invest 80% into AA plus corporate. So this is a relatively safer approach when it comes to debt funds. And then we have some credit risk funds, which is slightly riskier. Okay, it doesn't look at AA plus, it looks at ones below that. So it looks at credit risky companies so that you get some higher return. Okay, and then we have other things like a gilt fund. 80% of the money by gilt fund goes into government securities. So this is relatively safer. So this is something you can consider if you want, if you have money in your savings account and you want something which is very safer, you can look at gilt funds. Okay, so these are investing in securities backed by the country, so they can, it's much more safer. And overnight, which is the most safest of all, because they invest in funds which mature overnight. So there's hardly any duration for that particular bond and it is much safer. So these are the different debt categories, and the best part about this is that within that you can find the best one. So if I click on SBI Magnum Gilt Fund, I know this is the best rated fund in that particular category. I don't have to do more homework now. Okay, I can either look at this fund or this fund. And if you scroll below, you can get all the hold and sell rated funds. Okay. And speaking about the portfolio of debt funds, you should understand, I spoke about, the government funds, so it's looking into only sovereign fund rating. So these are very safer. So if you have some money, I get a lot of questions in the webinar as to, I have some money, where should I park it for the next 3 months? Where should I park it for the next 6 months? This is where you can actually look at debt funds. So I've not spent much time into how you can allocate your portfolio. I've not spent much time into how you can actually create or start off investing. What I wanted to do in this particular event was just to break the different types of mutual funds in your head. So I'm just starting off with, making you understand the different schemes, sector funds, so on and so forth. Okay. And going forward, we will be in the next series, the next knowledge series, we'll be looking at how we rate mutual funds. Okay. I've showed you all the different ratings of buy, hold and sell what MarketsMojo provides, but how you should actually go about in comparing different mutual funds and selecting this particular one. You might not like the best fund, you might like the third best one or the fourth best one. So what's more personal to you, we'll be looking at performance, risk and portfolio strength. Okay. And also, as I said, we'll be shortlisting the best funds within each category for your particular portfolio. This would be the next series. This series, I only wanted you all to understand the structure of mutual funds. How are mutual funds made? What are the objectives? What are the different types? We looked at debt, we looked at equity, and I've not touched on hybrid because hybrid is basically a mixture of debt and equity. Okay, within debt, what are the different types? Within equity, what are the different types? And most importantly, the 2 rules which I spoke about. Okay, so this is all what I've covered in this particular event. Okay, and also you can take this particular webinar offer. It's much cheaper than the plan available on the website. Okay, you can get the free mutual fund transactions, 3 months free because you're a webinar attendee, and lastly a massive 33% discount. I'll ask Mehta to drop the link in the chat box, and let's open the floor to Q&A session. Let's talk about different mutual funds today.
The first question for today is from Mr. Ankit. Do you have any preference for small cap funds? Please give me some suggestions.
I don't have any preference as such. What I've gone straight to the particular mutual fund website and I've looked at what are the best rated small cap funds. But since you asked me this question, it's quite simple, sir. You don't need to actually find out my preference because compared to the system, it's looking at much more parameters. Okay, so I'll simply just give me a second. Yeah, if you just share my screen. So simply you can just add in small cap over here. So, and let's go to, yeah, since we are on MF anyway. Now if you click any of the mutual fund schemes, now this is category equity small cap. Within that, it will give you the best ones. Okay. So within that, it will give you, now for example, if you see Karnara Robeco has given 5.78% return in 1 year, but Quant small cap has given better return. So why is this first and why is this third? Remember, we don't only look at the last 1 year return, we look at many other factors. Okay, so the best mutual fund into small cap, you can simply, look at this particular ones over here. Okay, yeah.
The next question is from Ms. Rutika. Why have you not covered drawdown and risk? Should it be considered?
Yes, it should be considered. The reason I didn't cover is that it will be in the next episode of the knowledge series. Drawdown and risk is really important. What I've seen is a lot of investors invest in mutual funds and think that their money is safe. But you have to understand, some mutual funds are as much as 40 to 30% drawdown. That's very risky. That means you're investing 1 lakh and your money is coming as low as 60,000. Drawdown and risk are two important factors. We will be covering them in the next event itself, when I'll be talking about how MarketsMojo evaluates mutual funds. So we will be covering them as well. It's very important.
The next question is from Mr. Saurabh. Is it a good idea to invest in SIP in a thematic fund like ICICI Prudential Technology Fund and similar ones?
I mean, you can look at technology funds. I actually spoke about this particular thing. What I believe is that if I want exposure to a particular sector, I go with Mojo stocks. So I go to the MarketsMojo section. I think IT might do well. I go to Mojo stocks directly because I think that's the right approach when it comes for me. I like more of risk, so I can do that. But if you don't have time to actually monitor the stock and so on and so forth, you can actually look at Prudential Technology Fund. Now the thing about this is that you have to understand from your overall portfolio, are you already allocated a lot to IT sector? So let's say you have a particular stock portfolio, let's say you have 10 to 15 stocks. And now 5 or 6 of them are already technology stocks. Should you buy a technology mutual fund? The answer is no. Remember, we spoke about not more than 30% in any sector. You have to look at your mutual funds too. If you already have high IT stocks in your portfolio, you can't have more exposure into these technology funds. But very risky funds, be careful, sectoral funds. That's why I spent some more time on that. It's much more risky and it has a very high drawdown. Yeah.
The next question is from Mr. Jairaj. Good evening, team. What is IDCW in mutual fund? Thanks.
So IDCW is, I don't know if you all remember, in the previous mutual fund, it used to be written dividend. Now the regulators have asked them to write IDCW. Okay. And even I'm not really sure about the particular full form, but it's income distribution cum capital withdrawal. So it's basically the erstwhile the dividend scheme funds. So nowadays when you search a fund, you'll see IDCW, you will stop seeing dividend. So the regulators have actually asked them to change. It's an income regulated thing. So you want regular income in your particular portfolio. That's when you look at IDCW funds.
The next question is from Mr. Bala Sundaram. Thanks, Jason, for this session on mutual funds. If we are to buy mutual funds unit through MarketsMojo, should we open a demat account with MarketsMojo?
No, it's not actually required. See, if you're purchasing an ETF or a stock, that's when you require your demat account. I don't think you require your demat account when it comes to mutual funds. You have to simply do your KYC process and then you can start off purchasing. So no, you don't have to open a demat account on MarketsMojo. I think you can simply do your PAN, KYC and register. And then you can simply start off with investing. So you have to, I think, even link your bank account. And then you can simply start off with investing. It's very simple.
The next question is from Mr. Rajesh. How to create multiple mutual fund portfolios for self and spouse as both have separate PAN?
This feature is currently not available, where you're talking about you have two different or separate PANs. I don't think it's available. I'll speak to the team though, so you can have. So as you know, in the MarketsMojo portfolio tracker, you have an option for one account, two account, three accounts, so on and so forth. This particular thing is not actually available. I'll speak to the team and see how you can integrate multiple PANs, and I think then it will be able. So now if you can't, you can actually add it in your portfolio, but I'll speak to the team and see if we can have this feature. It's a really good suggestion. So might have just note this down. We might think of adding this in our mutual fund tracker as well.
The next question is from Mr. Srihari. Dear Mr. Jason, does debt fund beat FD rates of banks in return?
So as per the data, as per how the performance has been, let's say our FD gives you some 4-5% return, the category average of debt funds would be 5 or 6%. There's a very small marginal difference of 1 or 2%. Unless you actually catch a very good debt fund, if you actually look at the ratings and you see one of the best debt fund, it might give you slightly higher, let's say 300 or 400 basis points. In terms of return, yes, it does beat. So it does beat. It's not a very big margin. It's not like it beats it by 10-20%. You will find a difference of, let's say, 2 or 3%. But the reason you could consider debt funds versus FD is that FD has a lock-in period, sir. So let's say you have 2 lakhs in hand, you put in an FD. There's a lock-in period, so you will have to actually break that FD when you want to exit. With debt funds, it's not that the case. That's not the case. You can simply exit early. With returns, yes, there is a difference, but not a very exciting one. Slightly 1, 2 or 2.5% in very, very different scenarios. If you just share my screen. Okay, so I'll just go to research any mutual fund. So it also depends on the category of debt funds. If you're looking at a very simple overnight fund, then it won't be possible. But if you look at, let's say, this particular Franklin India Credit Risk Fund, or I'll take another one actually. Let's say this one, UTI Bond Fund Direct. So this has given 11% return, and FD doesn't give that much. But you have to understand what exactly this fund is. So it has invested in Bajaj Finance debt, which is a bit risky. Then it has invested in GSEC. So you can also get the weightage over here when you open. This is quite interesting because you know what the debt fund is investing in. So yes, better returns than FDs. But one best thing is about I can know if I invested in this fund, I can remove money later. So that's helpful.
The next question is from Mr. Pandey. Hi Jason, good to see you on the other side of camera. From last 5 years, I am doing SIP in Aditya Birla SL Floating Rate Fund Growth and HSBC Aggressive Hybrid Fund Regular Growth. They are giving me average 6% returns yearly. Please advise if I should move out to some other mutual funds.
Sure, I'll just simply search them on the screen itself so that we get an idea. If you just share my screen, sir. Okay, so it's a floater fund. Currently, we don't have ratings for this particular floater fund. If you could just flash the question again, Amir. Okay. So you're the investor saying that he's doing an SIP and SL rating, and they're giving around 6% returns average. So this is something which is close to expectations. So if you see here, the fund is given 5.36, the peer average is 4.57. So when you look at this floating rate category, this is a fund which has beaten the particular peer average. Okay. So now if you're not happy with 6%, so that means you're actually looking at higher returns. So then you'll have to look at equity or let's say credit risky debt funds. But if you're happy with this floating rate fund, it's actually doing better than the peer average. Okay. We don't have a rating for that, so I can't comment. But it is actually doing better than the average funds in that category. Now let's look at HSC Aggressive Hybrid Fund. Okay. So this is a clear sell rank, sir. Okay, out of 34 funds, this is given a sell ranking. You can look at, exiting that particular scheme and come to these buy rated schemes instead. Because it is a sell rating, sir. So you see the return in the last 3 years are underperforming the category average of 13.82 is the category average. Now you're talking about hybrid funds. So as I said, hybrid funds have a mixed portfolio. Okay, so if you see the portfolio here, there's a stock, there's one stock, there's the debt. Okay, again, stock. So hybrid by itself looks at a mixture of debt and equity. Okay, so you can see 4% in debt, then another 2.76% in debt. So it's a hybrid way of investing, but I look at the returns, I'm not that happy with it, sir. This is something you could simply sell. And then you have 3 funds within the hybrid criteria. Okay, so you have equity and debt. So as I said, hybrid is simply a mixture of equity and debt. And look at these funds. These funds are done much better. So look at Bank of India. Okay, if you could just hide the question, this particular fund has given 20.64% 3-year returns. This is very good performance. Okay, if your money is compounding on 20% year on, it's a quite good performance over here. Okay, so instead of, why don't you look at these particular funds instead of that particular one? Yeah.
The next question is from Mr. Dilip. Hi sir, which are the better mutual funds to claim income tax relief up to 1.5 lakhs?
So here you look at ELSS schemes. Okay, they're equity linked savings schemes. And yes, you can actually, there's a 1.5 lakh tax exemption. I think that's for the old tax regime. Okay, you can look at this, and you have to look at ELSS. So the thing about ELSS is I didn't have a very good experience personally. Your money is locked in for 3 years, and I am of a different approach. I think you should pay tax. You earn more, you should pay more tax, and you should invest more and pay more tax on that as well. In that game of actually saving on some tax, you're putting 1.5 lakhs in a scheme which is locked in for 3 years. If you're comfortable with that and you don't want to, actually spend time in investing here and there, then you can look at ELSS schemes. Some of the ELSS schemes have not performed that well. I was not really happy with the returns 3 years back when I put in ELSS. Today I don't put it anymore because I feel that the tax relief you're actually getting there, that 1.5 lakh, let's say you invested in a good portfolio, it might get more returns and you might actually not even think about this tax relief. So 1.5 lakh is a very big sum. If you're able to break even and save on some tax, you can do that. But if you ask me personally, I look at investing that 1.5 lakh in a better stock, so I can make more returns instead.
The next question is from Mr. Kanan. Can you recommend some suitable mutual funds for senior citizens for regular income?
So you're talking about regular income, then you have to look at the IDCW option, which is the dividend option. So you'll have to look at some dividend yield funds because then you'll get some payback into your wallet. Okay, so for senior citizens, it's a very vague question, so I'll have to actually understand. Before this webinar, I was also seeing a particular video in which this investor said the proportion of your allocation of your portfolio should be as per your age. So let's say I'm 24 years old, so I should have 24% in debt and 76% in equity. So now I become 40 years old, I have 40% in debt, 60% in equity. So that's one way people do it, and I think it's a really wrong way to look at it. You might be a citizen, so I don't know your risk appetite. But if you're talking about regular income, why don't you check the best dividend yield funds on MarketsMojo and actually invest in them? Suitable for MFs, so then you'll have to look at a hybrid fund as well, because I don't know how much risk you can take. So it totally depends. If you can give me some more details on what exactly is your current exposure into equity. Are you very well exposed into equity? Then you'll have to look at a debt or a hybrid fund when it comes to regular income.
The next question is from Mr. Mahendra. How to check credit rating of the fund?
So credit rating of a fund, if you just share my screen and let's go to any particular debt fund. So you can go to portfolio and understand the credit rating of that particular debt. Okay, I don't think it's currently mentioned over here, but okay, so I don't think currently some of the, otherwise it should be mentioned as AAA, AA. I don't think it's currently mentioned. I'll have a look at the team. If we can pull this data and actually show it to you. The rating we have is currently whether you should buy, hold or sell this mutual fund. It's a good question. I'll take it up. And if we have the data, it won't take us much time to actually display it. So I'll see if that's possible as well.
The next question is from Mr. Jayant. Some of the mutual funds you showed had about 5% returns for 1 year. Why would one invest in these when one can get a 1 year FD for more? I now know from you the difference about liquidity.
Yes, I think if you know the difference about liquidity, that's the major reason. I personally prefer going into debt than actually looking into FTs. 5 or 6% is yet low. When I spoke to some of my team members as well, when they were saying, what's the big difference, Jason? You're getting some 5%, let's say on FD, you're getting some 6% on debt funds. What's the big difference? And also, when you invest in the FD, they consider it much safer because the bank will actually guarantee you that particular deposit. And when you invest in a debt fund, that company might go bust and you might lose some of your particular NAV. You will have to actually research and come into a particular proper debt strategy. So if you see some of the debt funds that have given 10, 11% as well. Okay, it's not a big risk and return playoff. It's something you'll have to take as a personal decision. Totally depends on the liquidity, as you mentioned. But yes, some of the debt funds are quite disappointing, and that's the reason I'm not putting a lot of my money into debt funds, because I'm not here for 5 and 6% returns.
The next question is from Mr. Sridhar. Hi Jason, good evening. Thank you so much for the detailed explanation about mutual funds. When I upload my existing mutual funds, will MarketsMojo give an overall recommendation taking into my stocks and mutual funds, considering the equity and debt allocation? Thanks.
Currently, it's not available. So currently, how we're looking at investments, you're looking at stocks separately and mutual funds separately. But as Mohit said, in our wealth planning journey, we will be thinking of adding this as well. Okay, so currently you don't get a particular diversification of how much your mutual fund is into debt and equity, how much of it. We are in just a initial stage, but this is one of the plans. Obviously, future on we will be looking at your net asset as an overall allocation. Okay, you don't have this option right now. If you see the stocks page has a different tracker, and the mutual fund is currently you can track it separately. We will be merging them soon down the line, and I hope we can actually give you an overall, a wholesome analysis when it comes to how much debt you have and how much equity you have.
The next question is from Mr. Alu. Sir, for regular monthly income, what type of fund is available in MarketsMojo? How much capital is required?
I would not say invest in mutual funds for looking at regular income. Okay, so you might be thinking of investing in a dividend scheme. I would not say do that particularly. Now, for regular monthly income, it totally depends how much is the requirement of yours. Are you looking for just 10 to 15,000 a month? So that means you'll have to invest that much particular capital, let's say 5 or 6 lakhs. If you're looking for more regular income, you'll have to invest more in that particular dividend yield fund. But if you're looking at regular income, you'll have to look at one of those funds. Now, when you invest in a particular dividend yield fund, and if you're looking at dividends, I don't think that's the best way. You hardly get any dividend. I don't know if any of you all are actually investing in dividend yield funds. Just write it down in the chat box. How much dividend are you actually getting? Why don't you go to the screener, look at high dividend yield companies and actually invest in a group of them? Because the amount of dividend you're getting in these particular funds might be quite minimal. Okay, so I would not suggest doing this particular approach. Mr. Sunil and Mohit might have a very different opinion, but I don't think I would be suggesting this particular approach. Okay, I think we are done with the Q&A session, Mehta. Okay, so thanks a lot everyone for coming for this particular knowledge series event. I hope I was able to actually break down the different types of mutual fund schemes. I have not gone in depth as to how we rate and rank them. This is why I'll be doing the next particular series probably next Wednesday. Tomorrow we have an event for our Infinity investors. We'll have our CEO and founder Dr. Mohit in front of you to answer some questions. And on Saturday I'll be doing an interesting event. I don't know if many of you all remember of picking winning stocks from the news. I'm going to extend that particular series. And from Monday to Friday, all the different news articles, I'll be showing you all how you can actually use MarketsMojo to create investment ideas from that particular news. So once again, thanks a lot everyone for joining the event. Goodbye and have a great evening. Thank you so much.